And don't forget, June 5th, we have our first time homebuyer webinar. It's actually happening every month. So anytime you have any buyers that you run into that want to learn more about the process, there's a Q&A part at the end of the webinar. They can register. So you just have to go to monthlyhomebuyerwebinars.com or the Woolen Mortgage Team website to register. And it's free. It's only about 30 minutes of content, and then there's a Q&A after that. It's quick. It goes over some simple things for people to really understand before they get into the process and to help them get prepared for purchasing. And again, that's the first Friday of every month at noon. So this one, I think we have close to 30 people, buyers on this next one. So we do tag them to the realtor that referred them, so you will have them in your database, and we can hopefully turn them into buyers in the near future. So without further ado, I'm going to jump right into today's Monday morning mortgage update. Again, my name is Sean Woolen with the Woolen Mortgage Team. And what is happening in the world of mortgage? Well, we saw a little bit of chaos over the weekend. We were very close to a potential deal with Iran, and then it didn't happen. So we've seen this trend over the last several months since February 28th when the war started. I'm going to share my screen real fast and show you kind of what's happening and what we can expect as we move forward. So just bear with me one moment while I move this over here. So we've got let me share the right screen here. Share, screen 3, boom. There we go. Okay, so when we look at the markets today, if you look at the Fannie Mae 30-year bond, you can see last week we had a really horrible beginning of May. Like we started out good and then we just lost our shorts and rates got pretty bad, almost hit 7% across the board. We did rebound very nicely on the news that Iran there's going to be a deal. And then Israel made a pretty big attack over the weekend, and the ceasefire basically is null and void, and we lost quite a bit so far today. So we went right through this Fibonacci level. We went through the 25-day moving average, and we have a lot more room to go. It's not looking good for this week. There's a lot more room to fall. Remember when they go through a level of resistance right here, it's almost like falling through the attic. You fall pretty quickly to the next floor of support. So this will most likely go all the way down here, depending on what the 10-year does. So if you look at the 10-year, we were down 7 basis points. Or it was up 7 basis points. Now it's only up 4. So it went up to this Fibonacci level, kind of bounced back, but we're above the 25-day moving average. So this may keep us in a tight range, but it's just not looking good. We had a good run where the 10-year lost quite a bit last week, but this on the Fannie Mae, this is not a good sign. So I locked a few before this really hit, but any new contracts coming in, we may want to lock ahead of time because we could potentially lose another, what is this? This is another 20 basis points, which is about an eighth in rate. So that's where we're at right now. As far as where rates are actually, let's have a look at that real fast. So if you look at the Fannie Mae 30-year fixed, it got up to 6.8 at its peak this last month. Now we're at 6.6. So we're down to 6.5 last week. And then this morning, we're up a little higher on the 30-year. The 15-year, we're still in the low sixes. On a 30-year, we're on the jumbo side. We're in the mid to high 6 to 6.7 average. Remember, jumbo, every single lender has their own individual rates because they're all portfolio loans. There's no Fannie Mae or Freddie Mac in the jumbo world. It's all portfolio loans. So like Wells, Chase, all of the big banks have them. Then there's like PennyMac, then there's Citi, and then there's a ton. There's just an absolute ton. Redwood. I mean, I can go on and on and on. They all have different rates depending on how much volume they want, so we can shop those different rates. Adjustable rate mortgages are in the low 7 or low 6s. I'm sorry. And then you can also get them in the high fives. We do have a portfolio product within Waterstone Bank that has rates in the high fives. So that's a really good option. FHA in the low sixes if their credit is good, and same with VA. So not terrible, but look at the trend. It's very negative. Um, it's not it's not good when you see the Fannie Mae down 20 basis points when you start out the day. Um, Seeing these charts on the candlestick charts like this, the big candle like this is not a good sign. So hopefully they'll hold and we'll hold the gains, some of the gains we had last week. But that's kind of where we are right now in the market. And this does bring up lender and rate buy downs, which I'm going to go over again as we jump into this. So if you look at what's happening in the marketplace, you look at builders and why they're getting some competition, stealing some competition against the normal resale market. They are offering a lot of buy down options. Anyone can offer the same buy down options that a builder does. It's just we need to get them from the seller because the builder or the seller, whoever's the seller, pays for them. Now I'm talking the temporary buy down. So what I've done is I've put together this report that shows how they work, and what the rates would be the first year, second year, third year. So if we look at, let me just get this thing out of here. If we look at a 3-2-1 buy down, you can see that the rate the first year, if the rate is 6.5, the rate the first year is 3.5. Now, the way these temporary buy down works, I want to make sure you all understand this so we can negotiate these for our buyers. The savings that the buyers get for these temporary rate buy downs, the savings over that 3 years or 2 years, whichever buy down option they choose, the savings amount is exactly the cost of that. So it doesn't make sense for the buyers to pay for it because they're basically giving themselves money to supplement themselves on the payment. But it does make sense for the sellers to pay for it. So in this case, on a 3-2-1 buy down, the initial cost is $24,820 for a $575 purchase price. So now with that being said, their first rate, the rate is actually 6.5 the whole time. But the first year, their payment is equal to a rate that would be 3.5. The way it works is this. The rate is 6.5. They'll see on their payment coupon, here's the payment, and then it will show a seller paid subsidy to make the payment equal to that of a rate of 3% lower that first year. So in the first year, their payment is equal to 3.5, but we dip into that piggy bank that the seller funded to supplement the payment because in reality, the interest rate is still 6.5. It's just we're supplementing the payment every month from that buyer, from the seller's funds that they gave us to make their payment equal to that 3.5 the first year, 4.5 the second, 5.5 the third, and then it goes back to 6.5 for the remaining part of the year. Now, the cost of these, because it's equal to the savings, the rate, the loan amount, the down payment, all of that has a big impact on the overall cost. So if you look at the cost of a rate buy down, you can see if you do like a 3-2-1 buy down and we have a loan amount of 500,000, and let's just say the rate is 6.6 based on today's average. The cost of that on a 3-2-1 buy down is $22,476. Now, at the seller, if you make an offer and the seller's, I'm not paying all of that, but I'll give you 10. You may be able to do a 2-1 buy down. So if you do a 2-1 buy down, which is 2% lower the first year, it's only 11,435. So you're closer. So there's different options. You can do a 2-1 buy down, which doesn't get you the full 3% lower the first year. It's only 2% lower the first year. So you can do any of these. Now, I do have a really cool, a really exciting thing to tell you. We do have a free 1-year buy down that we're offering now from the Woolen Mortgage Team here at Waterstone. So if you have any customers that are looking to do a purchase and the 1-year buy down would be beneficial to them, we do offer a free 1-year buy down on those on either a conventional or an FHA loan. So that's somewhat exciting. You'll see that flyer a little bit later. We'll email that
They're
out.
gonna kick in 1%?
Free 1%. So the first year it's going to be 1% below. So let me show you what that I'll show you a sneak preview of the flyer here. Hold on one second. Let me see if I can pull it up. Hold on one second. Let me see if I can pull it up.
Sean, I know you said it's for FHA. What about like jumbo or anything like that?
No, jumbo does not get those privileges, unfortunately, because each jumbo lender has their own rules. But good question. That is a really good question. Let me see if I can. I'll send you the flyer so you guys, because I have too many icons on my desktop to look at. It's making me crazy. But it is a great little tool. So keep that in mind for your buyers. And be sending that out to everyone to look at. And as far as the 3-2-1 buy down, the temporary buy downs, permanent buy downs are a little different because on a permanent buy down, it's a little bit more expensive to buy the rate down. Um, it's about 1% for every 3/8 in rate. So a good way, a rate of 6.375. If you wanted to get a rate of 6%, that's 3/8 better in rate. It would typically cost about one discount point to get that. A discount point is a percentage of the loan amount. So if it's a $500,000 loan, one discount point would be $5,000. So you could pay that and have that rate be lower the entire length of the majority of the term. And you can also combine a permanent rate buy down and the temporary rate buy down. So let's just say you're doing 20% down on a conventional and they're giving you 6%. And we have a lot of money there. You can use 2% of it to buy the rate down to like 5.75 and then do a 3-2-1 on top of that and get a rate down to 2.75 the first year. So if you see all these builders advertising all this crazy rates, that's how they're doing it. They're doing a stacked buy down. They may do a permanent buy down and then the first year, or they're doing a 2-year buy down, but the sellers are paying for it. The builders are paying for it. It's built into the price of the home. Lenders can't pay for it. It's not allowed. The builder or the seller is the only one that can pay for that temporary rate buy down. But really, as rates, if they spike back up again, we're going to need to have this as the forefront of our conversations with buyers. And one of the things I like to say is if I was a real estate agent working with a buyer and they were on the fence, I could say, if I was to get you a rate in the fives permanently, would you want to buy right now? That's a conversation I would have. Or if they're not ready and they would say, well, I could get a temporary rate buy down to have rates in the threes and then the first year and the fours the second. If I was to get you a payment equal to that right now, would you be comfortable buying in this market? Those are the types of conversations we're going to need to have with buyers as the rates, if they do spike up again, as we move forward into the summer months. So I know it's hot out there during the summer. I know a lot of people take vacations, but it is a conversation we need to have with those that are still on the fence that are looking to buy and maybe wanting to put it on hold for a while. And that old adage of marry the home and date the rate, it didn't work out very well for a lot of people because the rates didn't really come down to what they thought it would. But it is a true statement because you can always time a refinance when there's a dip. You can't really time a purchase perfectly when rates are at their lowest because you might not find the perfect house. So find the perfect house, figure it out with the refinance later. It is still a good motto to use, although it's somewhat cheesy, but it is true. So for the most part, it's not going to be an immediate in 6 months, but there will be opportunity to refinance in the future. And so rate buy downs, things we want to take away. We're offering a 1-year free rate buy down on FHA and on conventional loans, only for 1 year. And then it's only 1%. So if the rate's 6.75, we can have them at 5.75 the first year. You still have to qualify for the higher rate. So this does not help in qualifying, just helps with that first year. But other than that, it's going to be an interesting week. Hopefully rates will not continue to climb, but with the escalation, so to speak, with the Iran conflict and with oil spiking back up again, it doesn't look good. We really, really need this to be over before we're going to see rates dip again to where we want them to be. It's just going to be interesting. So we'll see how that goes. Keep the grind out there, guys. If you need anything over the weekends, evenings, I always work. I'm always here for you, and we will help you with anything that you guys need help with. So if you need flyers, if you need information, you want me to talk to buyers about different weird scenarios, I am always here for you. And I just want to say thank you for everything. Have a great week, everyone. If you do have any questions, feel free to stay on and we'll do a little Q&A. Other than that, you guys have a wonderful day.
Thank you, Sean.
You are very welcome.
Thanks, Sean. Appreciate it.
Anytime. You have a great day, Pat. All right, guys. Talk to you soon.